welcome to the deep dive. There's just so much information flying around, especially about finance. It's a lot.
It really is overwhelming sometimes.
Right. But today, we're trying to cut through some of that noise. We're doing a deep dive into something with, well, surprising strategic angles, the tax benefits of gold IRAs. And the big question we're kind of tackling is pretty fundamental for your retirement planning. Do you want those tax benefits now or later? Especially when you think about using precious metals.
And that now or later thing, it's really the core of it, as Doug Young's article over at Gold IRA Company's Bulletin puts it so well. It's not just about filling out tax forms differently.
Oh, no, exactly.
It's about, using these specific strategies as part of your bigger retirement picture.
Yeah.
Our goal here is really to unpack how these tax advantages work, the sort of nuances.
Yeah, help you navigate the options, right? Get a perspective that goes beyond just, oh, gold is an investment.
Precisely. We want you, the listener, to get those aha moments. You want quick but solid info. And we think there are real strategic benefits here people might not realize.
Definitely. We'll look at what makes these gold IRAs tick, that big choice, traditional versus Roth, and, the tax perks, both short-term and long-term.
So just to level set quickly, a gold IRA, it's a type of individual retirement account, right?
Yeah.
But the distinct feature is it lets you hold actual physical precious metals, gold, silver, platinum, palladium.
Tangible assets.
Right. And the real power comes when you combine that with the tax rules. It's not just about diversification. It's about making that diversification work harder for you tax-wise.
And what's always interesting about gold specifically, beyond taxes, is that historical role. It's seen as a hedge, right? Against inflation, economic wobbles.
Absolutely.
How does that protective quality kind of mesh with these tax benefits? Does it create something extra resilient?
I think it really does. It's a powerful synergy, as you said. You get the stability or perceived stability of a physical asset, something that often behaves differently than stocks when things get choppy.
The counterbalance.
Exactly. And then you wrap that in a tax advantage structure, which just boosts its long-term potential. It forces a different kind of thinking about security beyond just chasing market returns.
Okay, so if the big question is now or later on taxes, let's dive right into that main choice. Traditional versus Roth Gold IRAs. What's the fundamental tax difference? Why does it matter so much?
Yeah, it boils down to when you deal with the tax man, basically. With a traditional gold IRA, you're typically funding it with pre-tax dollars.
Money that hasn't been taxed yet.
Correct. Which means your contributions might be tax deductible for the year you make them.
Okay, so that could lower your current tax bill.
It could, yeah. Lower your taxable income right now. The trade-off, though, is that you pay income tax on the withdrawals when you take the money out in retirement.
Okay. So the thinking there is maybe you'll be in a lower tax bracket when you retire.
Yeah. That's often the calculation, yes. If you expect your income, and thus your tax rate, to be lower later on, traditional can look appealing.
Got it. So traditional is tax break now, pay taxes later. Roth must be the opposite then.
Exactly. Flips it right around.
Right.
Roth Gold IRAs, you fund those with post-tax dollars.
Money you've already paid taxes on.
Yep. So because of that, your contributions aren't tax deductible now. No immediate tax break on the contribution itself.
Okay, but what's the payoff?
The payoff comes later, and it's potentially huge. All your qualified withdrawals and retirement contributions and earnings are completely tax-free.
Wow. Okay. Tax-free growth and withdrawals.
Correct. So if you think you might be in a higher tax bracket when you retire, or you just value that certainty of knowing the money is yours free and clear later, Roth is very attractive.
That tax certainty sounds really appealing. Okay, so let's unpack the now benefits a bit more, the stuff you get with the traditional IRA. First up, tax deferment. How does that actually help your money grow faster?
Well, tax deferment is powerful because it lets your investment earnings compound year after year without getting hit by taxes annually.
So the tax drag isn't slowing things down each year.
Precisely. Every dollar of gain can generate more gains, and the IRS doesn't take a cut until you actually withdraw the funds, potentially decades later. It lets the snowball effect, really work.
Right, and then there's the more immediate hit, the tax deductions themselves. That puts money back in your pocket this year.
Absolutely. It's a direct reduction of your taxable income for the year you contribute. Let's use the example from the article.
Okay.
Say you put $5,000 into your traditional gold IRA.
Okay.
And maybe you're in the 24% federal tax bracket. That deduction could save you $1,200 on your tax bill for that year, instantly.
That's a tangible saving. Very clear benefit now.
Oh, clear.
Now, a lot of people listening probably have retirement funds already, like in a 401k or maybe an old IRA. Moving that money into a Gold IRA without triggering taxes sounds great. How do those tax-free rollovers work? Is there a catch?
It's a super common strategy, and yeah, very beneficial. The absolute key, the thing you have to get right, is doing a direct transfer.
Meaning the money goes straight from the old provider to the new one.
Exactly. You instruct your current 401k administrator or IRA custodian to send the funds directly to your new Gold IRA custodian. It's often called a trustee-to-trustee transfer.
Why is that so important?
Because if the money never touches your hands, there's generally no tax event, no withholding, no penalties. If they send you a check instead, you can still roll it over, but you only have 60 days to get it into the new account.
Ah, the 60-day rule. Easy to mess that up.
Very easy. And they might withhold taxes automatically if you take the check yourself. So direct transfer is just cleaner, safer, avoids potential headache.
Okay, direct transfer.
Yeah.
Got it. So that covers the now benefits pretty well. Deferral, deductions, rollovers. But what about playing the long game? Aiming for tax freedom in retirement. That brings us back to Roth and the later benefits.
That's right. And the big one there is that tax-free growth potential we touched on. It's hard to overstate how powerful that can be over time.
Give us an example.
Okay, sure. Let's say you invest $10,000 in a Roth Gold IRA. And over, 20 or 30 years, through the appreciation of the metals, it grows to $50,000.
Nice growth.
Yeah. Now, when you take that $50,000 out in retirement, assuming you meet the conditions like age and holding period, that entire $40,000 gain, completely tax-free.
Zero tax on the profit.
Zero tax. Compare that to a traditional IRA or a regular brokerage account where that $40,000 gain would be taxed as income. The difference can be substantial, especially if tax rates go up or you're in a high bracket then.
Yeah, that's a really compelling later benefit. The article also mentions something called the Savers Tax Credit. How does that fit in? Is it for everyone?
Ah, the Savers Credit. It's a great one, but often overlooked. It's specifically designed to help low and moderate income folks save for retirement. It's not a deduction, it's a credit.
Which is better, right? Reduces your tax bill dollar for dollar.
Exactly. A credit is more valuable than a deduction. Depending on your income and filing status, this credit can be worth up to 50% of the first $2,000 you contribute to an IRA, including a Gold IRA.
So contribute $2,000, potentially get a $1,000 credit back on your taxes.
Potentially, yes. There are income limits, of course. And you have to be 18 or older, not a full-time student, and not claimed as a dependent on someone else's return. But for those who qualify, it's a fantastic boost.
Definitely something people should check if they meet those income requirements. Okay, thinking even further down the line. What about inheritance? Passing these assets on. Are there tax advantages for your heirs with Gold IRAs?
Yes, there can be, particularly with traditional Gold IRAs. When you pass on a traditional IRA, you beneficiaries, your heirs, they inherit it, but it generally keeps its tax-deferred status.
Meaning they don't owe tax immediately when they inherit it.
Correct. They typically only owe income tax when they actually withdraw funds from the inherited IRA. This gives them flexibility. They might be able to stretch withdrawals over many years, potentially keeping themselves in lower tax brackets.
So they can manage the tax impact over time.
Exactly. They can defer the taxes and potentially minimize the total tax bite compared to inheriting assets that would trigger immediate taxes. Roth IRAs have different rules for heirs, but they generally inherit the assets tax-free as well, which is also a significant benefit.
Okay, so lots to think about there. Let's shift gears slightly to strategy. You've decided on traditional or Roth, maybe rolled over some funds. How do you optimize your Gold IRA? The article mentions timing contributions. Does it really matter when you contribute during the year?
It can, yeah. Contributing earlier in the year, say in January or February, gives your money the maximum amount of time to potentially grow within that tax year.
More time for compounding.
Right. Whether it's tax-deferred growth in a traditional or tax-free growth in a Roth, more time is generally better. It also lets you potentially benefit from any price movements in the metals throughout the year.
Makes sense. But what if you're like me, and you tend to think about this stuff closer to the tax deadline? Is there still a strategic reason to contribute late in the year?
Oh, absolutely. Making contributions right up until the tax filing deadline, often mid-April of the following year for the prior tax year, can be really smart.
How so?
Well, it gives you a clear picture of your income for the year that just ended. You might realize you need a bigger deduction to lower your tax bill, so you max out your traditional IRA contribution. Or maybe you find you qualify for that Savers credit we talked about.
Ah, so it's a last-minute tax planning tool.
Exactly. It provides flexibility based on your actual numbers for the year.
Okay, another critical point.
Yeah.
You can't just stuff any gold coin or bar into these IRAs, right? The IRS has rules.
Oh, absolutely crucial. This isn't like buying coins to keep in your safe at home. For an IRA, the metals have to meet specific IRS purity standards.
What are those standards generally?
Typically for gold, it needs to be 99.5% pure, which is 24 karat essentially, although there's a specific exception for the 22 karat American Gold Eagle coin. For silver, platinum, and palladium, the usual minimum is 99.9% purity.
So things like American Gold Eagles, Canadian Gold Maple Leafs, those usually qualify.
Yes, those are very common examples of IRS-approved coins. Certain bars and rounds from accredited refiners also qualify. But the key takeaway is you must verify with your Gold IRA company.
Don't just assume.
Never assume. They know the rules. They know which specific products meet the IRS requirements. Buying the wrong thing could lead to, well, significant problems and penalties.
Yeah, they don't want that. Which leads perfectly into the next point,
Mhm.
choosing a reliable Gold IRA company. Why is this step so vital? Can't you just do it yourself?
Not really. Setting up and managing a Gold IRA is more complex than a standard IRA holding stocks or bonds. You need a specialized custodian that handles precious metals, and you need secure, approved storage facilities.
Okay.
A good Gold IRA company acts as your guide and facilitator through all of that. They help you open the account with the right custodian. They assist with selecting and purchasing the IRS-approved metals. They coordinate the shipping to the secure depository.
So they handle the logistics and paperwork.
Right. And they ensure everything stays compliant with IRS rules. Choosing a reputable, experienced company is honestly one of the most important decisions in the whole process. They make sure it's done right.
Okay, that makes a lot of sense. One last common question that pops up,
Uh-huh.
the early withdrawal penalty. Taking money out before age 59 and a half usually means a 10% penalty, right?
Yeah.
Is that always the case with Gold IRAs too?
Yes, that 10% penalty generally applies to withdrawals before age 59 and a half from any IRA, including Gold IRAs, on top of any regular income tax due if it's a traditional IRA.
But are there exceptions?
There are. The IRS does allow penalty-free early withdrawals under certain specific circumstances. Things like using the money for a first-time home purchase, up to a limit, certain higher education expenses, unreimbursed medical expenses that exceed a certain percentage of your income, or if you become totally and permanently disabled.
So there's some flexibility, but only in specific hardship situations, basically.
Pretty much. It's definitely not something you want to plan on doing. The penalty can really sting. It pays to understand those rules clearly before you ever need to consider an early withdrawal.
Okay, so wrapping this all up, bringing it back to that core question, now or later?
It really is the heart of it. The traditional Gold IRA offers that potential immediate gratification, the tax deduction now, the tax-deferred growth. The Roth Gold IRA asks you to pay taxes now for that potentially very powerful benefit of tax-free income later in life.
And layered on top of that is the unique nature of gold itself, that diversification, that potential hedge against volatility in other markets.
Exactly. It's a combination of a tangible asset strategy and a tax strategy tailored to whether you prioritize immediate benefits or long-term tax freedom.
What really strikes me is how this isn't just an investment decision, it's a tax planning decision tied to your future outlook.
Absolutely. Which is why, while we've hopefully shed some light on the mechanics and the choices,
This isn't financial advice.
definitely not. It's crucial to talk this through with your own qualified tax advisor or financial planner. They can help you see how these strategies fit or don't fit into your specific financial situation and goals.
Couldn't agree more. Okay, so let's leave our listeners with a final thought to chew on.
Right.
Beyond just the dollars and cents of tax breaks now versus later, thinking about a Gold IRA kind of forces you to confront bigger questions, doesn't it?
Yeah.
About what wealth really means, about stability, about legacy, especially when the financial world feels so unpredictable sometimes.
That's a great point.
So, the thought is this. What does true financial security look like to you, especially when things get rocky? And how might these unique accounts, with their blend of tangible assets and specific tax rules, potentially play a role in building a financial future that feels truly resilient, not just for you, but maybe for the people you care about too? Something to think about.